Hello, everyone. This is Dr. Duru from AHA Analytics with the Market Breadth, where I take a look at what the financial markets did in the last week and try to get a handle on what could be coming next. All right, this week ending October 17th, 2025, had just about everything for everybody. So the stock market was trying to recover from the previous week's explosion of fresh trade tensions between the US and China as the US president called China hostile and then said, everything will be fine. And then we went back and forth with the two countries trading barbs between each other and reassurances and barbs and reassurances and barbs. Anyway, the end result was a lot of churn, a lot of volatility. We had signs of recovery, but then we also had signs of failure. Also, hitting the screens, hitting the tickers was loan trouble, bad loans, roiled regional banks, and caused that sector to have a big sell-off. But we had big strength in small cap stocks. We had precious metals continuing to rally. Volatility remains elevated. Market breadth, most importantly to me, remains broken. Consumer facing stocks had some strength, had some weakness. It was a mix of so many things. And depending upon your perspective, you could basically almost find just what you want. But my basic point is, as I go into these various charts, is that market breadth remains broken. And yet, this could still be setting up the next melt up period for the stock market. All right, let's take a look. All right, this is my favorite technical indicator, the percentage of stocks trading above their 50-day moving averages, what I like to call AT50 for above the 50. What you can see here with this big circle is all of the churn that's happened in the last week, week and a half. And this right here, just follow my cursor, is what happened last Friday, the previous Friday, when market breadth fell 23%, 24%, 12 percentage points in terms of the percentage of stocks trading above the 50-day moving averages. And that became a level that we last saw way back in April. So this was a serious breakdown. As you can see in the subsequent 3 days, after the market got reassurances that things were supposedly fine with China, market breadth recovered in fact, all of its losses, almost all of its losses, and before fading a little bit here on Wednesday. But then the drama with the regional banks, and I'll cover those charts in a few, helped bring market breadth back down. And so you could see the market breadth remains broken. This downtrend that's been concerning me for a while is still in place. And my contention is that either this is the convulsion that gets us to oversold, which would be a major buying opportunity, or we'll shake out most of the motivated sellers in here. And then once all of this churn heals, that will be the beginning. Can't predict which scenario will be which, but this is the beginning of the end, I believe. Now, of course, the market went into this not caring about anything, particularly this government shutdown. So, for instance, if this government shutdown continues, who knows how many weeks, months, it was going to drag on consumer sentiment. It could drag on a whole bunch of other things, and the stock market might finally start to care. And of course, we have all sorts of other things going on. Any one of them could be a flare up that finally causes this market breadth to drop down to the oversold level, which is 20%. Now let's take a look at AT200, the percentage of stocks trading above their 200-day moving averages. And again, here's the circle, shows a lot of the recent churn. This longer term indicator of market breadth is much healthier than the shorter term one, particularly because at least in its breakdown, it's still pivoting around where it was when the S&P 500 was at its previous all-time high earlier in the year. So this gives me a little bit of encouragement that the healing process is underway. If AT200 breaks down to a new low, that would be a big red flag warning. Okay, let's go into the indices now. S&P 500 is the first one. And what you'll see here is, labeled here the first day of the government shutdown. We're finally trading below that. The market kind of celebrated, so to speak, the first day of the government shutdown by rallying to a new all-time high and then continued to drift higher until last Friday's big 2.7% loss. Now, when the market opened this week, the SP 500 gapped up, gained 1.6%, but you could see it didn't make any more progress. And this is the concerning part. In fact, if we zoom in, you could see here that resistance at the 20-day moving average, which is this dotted line, held firm the entire week. Buyers could not press through. But on the flip side, sellers at the lowest point for the S&P 500 couldn't break down below the 50-day moving average support line. So that holds as support. This is the red line. So we have basically a stalemate between buyers and sellers. Who's going to win? Well, it's going to be some sort of catalyst. And again, like I was saying, my contention is that this is all preparation for the next melt up phase, whether it starts after a breakdown or whether it just launches from here. So this is the kind of thing that I'll be looking for. The NASDAQ had a very similar pattern. I can zoom in just to confirm that you can see here again, trap between 20-day moving average resistance. Now the Nasdaq did not get as close to its 50-day moving average support as the S&P 500 did. So there's some proving that the buyers have to do that they can hold firm on um, any additional pressure. Now let's go to IWM, the iShares Russell 2000 ETF. This is the ETF of small caps. Amazingly, IWM did a lot better this week, a rare week of technical outperformance. So after falling 3% the previous Friday, IWM gapped up 2.8%. And by the next day, it had actually hit a new all-time high. That's how strong it was. So this turned out to be a great trading opportunity for me. I was able to take profits on my latest IWM calls. Again, as a reminder, I trade around a substantial core IWM position in shares, and then I opened up a new call option position on this pullback on Friday. So as always, we'll see what happens. But I'm very encouraged to see this. So like I said, there's some concerning signs and there's some encouraging signs. And IWM is actually pretty encouraging, even though it closed the week right below. Let me zoom in, right below its 20-day moving average. I still consider this pretty good trading action. Okay, now let's go to FXI, which is the iShares China Large Cap ETF, just to show the impact is also on various Chinese stocks. On that Friday, it dropped 5.4%, gapped up to start this week at 3.1%, but never, unlike the other indices, never recovered. Sorry, unlike IWM, but like the S&P 500 NASDAQ, never quite recovered those original losses. So it is still broken down as far as the technicals are concerned. And then even more concerning for FXI is that it's 20-day moving average is starting to downtrend. Now, let's take a look at semiconductors. What's a market review without looking at our favorite? The semiconductors, you could see last Friday down 5.8%, gapped up 4.4%, major gap up, and then proceeded to just about recover all of those losses. So semiconductors on a relative technical aspect are much, much stronger than the S&P 500 NASDAQ. So that was pretty impressive. So this is an encouraging sign. Also notice that the uptrend is still intact with the 20-day moving average. Let's zoom in here. Look at that. Perfect test, perfect retest. Looks like semiconductors actually want to break out higher. So if that happens, then I'm going to just assume that the next phase of melt up is ready to start. Now, rare earths was at the center of this latest trade dispute, flare up of tensions between US and China. This is ticker symbol REMX, VanEck Rare Earth and Strategic Metals ETF. And you have to be careful with this one because some of its components aren't uh, really rare earths, but they're kind of rare earth adjacent, but good enough. Now, it fell an amazing 7.1%. And now that sell-off surprised me, but before I could react to come in and buy REMX, it gapped up 14% the next day. I don't know why it took a while for people to realize that this is the thing to buy if the tensions are over the availability of rare earths. Now, The last 3 days, it finally cooled off back to 20-day moving average support. Now, let me zoom in so you can see. And right there is where we closed, and finally jumped in and bought some. Now, this is related to a recent short that I did talking about FOMO, the fear of missing out, and how to trade around that. So I don't, I didn't have FOMO, but this is kind of a related FOMO trade, which is I missed this entire move. And now I finally see a good setup. I'm going to buy a little something just in case it continues higher from here. So I have something in hand, but I'm actually hoping for lower prices because I want a much bigger position, but I want to pay less for it. So I'm looking for a test, say at the 50-day moving average and whatever other supports might come on lower prices. Hopefully, it's not going to go below the 200-day moving average because that would be very, very bearish. Now, there's some individual rare earth stocks that I also bought this week because I have some knowledge of it. A friend of mine really educates me on some of these plays. Ucore Rare Metals, UURAF, had a pullback. Now there's some really big moves. So trade sizing is so important here. On Monday to start the week, this stock went up as high as 10.75 before falling back down to $8.08, and it fell all the way down at its low on Friday around $4.49. I bought right here around the 20-day moving average support because that's the same thing I did with REMX. So you can see the huge range. I mean, this is about a 60% loss from the intraday all-time high down to the low point of the week. So very volatile stock. So I bought a little bit and we'll see what happens from here. Same thing happened with ESS Tech, ticker symbol GWH. Monster move. It had some news about a new 50 megawatt long duration energy storage pilot project, soared 142% one day, and then soared another 118% the next day. And actually was up even higher than that before fading. And you can see between the intraday high on Tuesday, which was 14, and the low point of the week, which was 4, that's just a massive, massive pullback. But it does provide a decent entry where I can start to nibble in a no regrets way as I look to see whether I can get even more shares cheaper, say on a test of 200-day moving average around $2.80. All right, let's start to move a little faster here. I did a short video on AMD and reasons to hold it. And I didn't even think about negative impacts of AMD's big news. And here is one negative impact: Astera Labs, ticker symbol ALAB. It fell 19% as people or traders, investors decided that there could be some problems with ALAB losing customers to AMD and its connectivity solutions. That remains to be seen. I'm not sure why the market didn't panic about this earlier or the day of the announcement that AMD had with OpenAI, but it is what it is. All right, let's continue to move on. Credo. I'm watching this for some topping like action. If you're a regular viewer, you remember I called out this breakout as a buying point. It worked out exceptionally well, even after Credo, ticker symbol CRDO, did a picture perfect test of 50-day moving average support, continued to rally higher. I took profit somewhere in here. I can't quite remember where, probably right ahead of earnings because I didn't want to hold through earnings. And now you can see it's pivoting around the 50-day moving average, the red line, as the 20-day moving average is moving down. So this is looking a little bit toppy. And of course, Credo Technology Group had a monster run, great run. So it could pull back 10, 20, even 25% and still not be a major deal in terms of the overall trajectory of the stock. All right, I want to take a look at some retailers because there is some interesting action here. The Spider S&P 500, the Spider S&P Retail ETF with the ticker symbol XRT had a big bearish breakdown below the 50-day moving average the previous week, ending in Friday's 3.1% loss. The rebound actually took it right to the 50-day moving average, and that's where it stalled. So XRT looks suspiciously bearish. The 20-day moving average is also moving down, so this really concerns me. There are some other consumer-facing stocks that are also in big trouble, technical trouble. Amazon.com, ticker symbol AMZN. You can see the 200-day moving average breakdown here. That is very concerning. In fact, it's almost confirmed as a bearish breakdown. Then on the flip side, we have Dine Brands Global, which I believe owns IHOP. It had 2 weeks ago or so a monster 200-day moving average breakout. That's about 7.7% gain. So this got on my radar as a potential buy, but I wanted to see how pricing action developed because you can see the closes were a little stretched. It pulled back, stopped perfectly here at the 20-day moving average. That's when I pounced and bought. And then I went ahead and took profits when it soared on no real news that I could find, 6.2% on Tuesday. And now I'm just kind of waiting and watching to see whether the stock will form a buyable base somewhere at support. And that's where I will start to accumulate shares that I hope to hold for a much longer. Dollar Tree, another one that had surprising amount of strength last week. It had this sloppy test of 200-day moving average support earlier in the previous week, but now it's rebounded and then it got almost to a test of the downtrending 50-day moving average. So it's kind of stuck now between support and resistance. But I'm keeping in mind that the CFO purchased $342,000 worth of shares. That was very encouraging. So encouraging that I sold a put options shortly after that. You could see that the close this past week saved that position, and I was able to close it out for near zero. Now let's move on to the other SAR of the day. So we had rare earths at the center of drama, and now we have regional banks at the center of drama. This is KRE, the regional banking ETF. You could see here, again, there was some news about bad loans. The regional banks were reporting earnings last week. Some were good, some were neutral, some were bad with those bad loans. And this is the end result, a bearish breakdown below the 200-day moving average. Friday, there's an the attempted recovery has started with a 1.6% gain. I can't remember the regional bank, but there was at least one regional bank that came out with encouraging earnings. So a lot of churn, but net result is bearish and a breakdown below the 200-day moving average. The other bigger financials, the money center banks and the large banks, are above 200-day moving average support, so that's good, but below the 50-day moving average resistance, and it's in the process of breaking down. So that's not looking good. And if I pull back, the other thing I really don't like about what XLF is doing is that it's still hanging around its former all-time high. It's also hanging around the topping pattern that evolved at the end of last year, beginning of this year, with a head and shoulders move. You can see there was a major breakdown during the April tariff drama and noise, but I don't like the fact that price hasn't been able to make any progress, net progress above this topping pattern. So financials are on my list of worries that I'm watching out for. Now let's take a look at the VIX. The other VIX remains elevated, so this is not good. Even with Friday's big fade, that's a very bullish thing. In fact, when there's a big fade like this, and that's the red bar here, there's where my cursor flashing over it, that's usually the sign that VIX has stopped surging and going up. This is what happened back in April. You could see this really big move down, 36%, and that was the beginning of the end of the VIX's surge. I'm thinking that's the same thing here, but I'm not sure how fast it's going to completely reverse the initial surge. Just like the last time, volatility is really damaged. It took quite some time for volatility to calm back down to where it was pre tariff drama. I think similar thing will happen here, and I think that as it's coming down, we could still see a lot of churn in the market indices and other stocks as volatility is starting to cool down. But this looks like the end of the overall surge. But the volatility index remains elevated, and so that means anything can happen at any time and with big moves. So just wanted to point that out. Another source of potential fear is the bond market, which with yields have been plummeting or have been dropping, sorry, and bond prices have been going up. This is TLT, the iShares 20 plus year Treasury Bond ETF. You can see it's been rallying in rally mode for about the last 2 weeks. It's at its highest point since the tariff drama. So this is a sign that the bond market is also concerned. Who else is concerned? Well, believe it or not, the cryptocurrency world, the crypto universe is also concerned because Bitcoin has been sliding ever since it made a new all-time high on Monday, October 6th. So that was almost 2 weeks ago. a week and a half ago, it has been sliding almost straight down and now is bearish below its 200-day moving average for the first time since April. So while Bitcoin, of course, is not the stock market, it has been correlated to risk appetite or risk sentiment, risk on, risk off, risk on, risk off. Right now, Bitcoin is acting like risk is off. So this is another sign that the market is worried. Bitcoin is not a safe haven. It is not a refuge from risk. You can just see it just in the sell-off that's happened in the last 2 weeks. There's been no safety there. Now, this is digital gold, real physical gold as represented here with GLD, the Spider Gold Shares ETF. Well, you can interpret it in many different ways. It broke out big time at the beginning of September and has been rallying almost straight up to multiple all-time highs with very little pullback until Friday. It's come back down 1.9%, which is pretty significant given the typical tiny moves in GLD. It's almost a topping pattern, but not quite. But this is a very strong move over these last, what is this, almost 2 months, almost straight up. So this is showing some kind of concern, whether it's concern with financial markets, inflation, or the economy. Silver as well, ticker symbol SLV, straight up. In fact, even more persistent gains than gold, all the way to ongoing all-time highs for silver. The commodity going the other direction is oil. So USO, the United States Oil Fund, is trading at levels last seen in around May, or maybe May or April. And oil has just been very weak. It's been cascading downward, kind of in choppiness, ever since the big pullback after fresh hostilities in the Middle East caused a lot of churn here. But you can see how USO sort of magically stopped right at its 2023 and 2024 intraday high. So technicals work even in the oil market at times. Now, let's round this out with the industrial stocks. JB Hunt, ticker symbol JBHT, had a big move, 22% post earnings. This was very surprising. You can see JB Hunt has been going nowhere and even down over the last few years. And so I just assumed that its earnings were going to paint more bad news for the industry. And instead, it soared higher and it's a bullish breakout above its 200-day moving average. So now it's gone from bearish to bullish, which is pretty good. And it's dragged some stocks up with it, like Landstar System, which I keep an eye on because it has a lot of trucking, I believe, between the US and Canada and Mexico. And of course, that's like ground zero in a lot of trade tensions. So it jumped almost as much as 8.1% in sympathy with JBHT, but then faded all the way to 3.5%. So that's a very bad. This means that the initial move, sellers took advantage of it in an opportunistic way and have concluded that actually the good news for JB Hunt is not really all that good for Landstar. We'll see what happens in their next earnings. Note how Landstar, if I just zoom in here, preceded this big move with another big move back on October 8th. And it also looks worse than JB Hunt in terms of topping out and now breaking down to multi-year lows. All right. Also in the industrial sector, we have Fastenal's company, ticker symbol FAST. It had a bad earnings report earlier this week, 14 at the beginning of this week, 7.5%. And it's right now trying to cling to 200-day moving average support. You can see how important this is. It's it's rarely been breached since the big move up that started in early 2023. This is a stock that I want to start accumulating. So I've already started to buy, even sold a put that actually went out worthless. So that was fine. Um, but you can see this is just a long-term runner. This is the kind of stock you want to buy when you're a young person and just wake up retired and then cash in. I mean, this is just an amazing run. It's like a tech stock in terms of this run. You can see it was trading for essentially pennies way back here in the in decades ago. Just absolutely amazing. All right. So in other words, I'm pointing it out to say that yes, it's going to have times like these, but Fastenal is such a central company to the industrial economy that it'll eventually right its ship. We don't know how long, but the history, if history is any guide, it's going to be a longer term winner from here. Caterpillar, ticker symbol CAT, is the last one. This is a fascinating one because Caterpillar had a double top earlier in the summer and early fall. It had sellers jumped in after earnings when the stock was trying to recover, but then the company said, "Hey, oops, we're going to have to increase the estimate of costs from tariffs." The stock came down. What was this? It lost 3.7%, but then it stopped cold at 50-day moving average support. Again, it's that red line. And then once that held, it rallied and almost never looked back, invalidated the double top, and now it's at all-time highs. And at the very end of this tail is one more concerning time because you can see a gap down below the candle from the all-time high. So this could be a topping action, and it did fall substantially. This was like a 2.6% loss. All right. Thank you for hanging in there. If you have any questions or comments, put them down below. Please subscribe to this channel if you want more content. And so the algorithm knows what's up, please like and share this content. Again, this is Dr. Duru producing this for your educational purposes. Please trade and invest with your own risk management and timelines in place. All right, take care and see you the next time. Remember, you can always read more details at my blog at drduru.com/122 all letters. Take care.